Well, welcome back to the last video on Chapter 5. This is Class 18 for Monday, Wednesday, Friday classes, and it's 12C for Tuesday, Thursday classes. So we're finishing up Chapter 5, which is merchandising. So all we've been doing is discussing how stores that sell merchandise have a few additional transactions they have to keep up with. And it pertains to inventory. Quite frankly, that's the only thing that's really different. You're buying and selling inventory. So just like any other business, a retailer will have been keeping track of transactions all month long, and for a retailer, those are sales. And so in addition to keeping track of sales, you keep track of the merchandise inventory perpetually by recognizing that expense, cost of goods sold. So you've been keeping track of things all along. Now you're to the end of the month or the year, and you may have some adjusting entries. And certainly you have to close the account. So that part of the accounting cycle is no different. The only difference is we have some inventory related accounts that we're going to have to adjust or close. So the other stuff's all the same in terms of adjusting entries and closing entries. A store would still maybe have prepaid rent that becomes rent expense, may have some office supplies that become supplies expense. So it may collect some accounts and have some revenue they didn't have on the books before. So none of that really changes. What is different is inventory, right? Let's face it, that's what's really different about a merchandiser. So let's talk about that. Let's talk about the adjusting entry. So what do you make? Well, the merchandise inventory count should stay current at all times in a perpetual inventory system. However, actual inventory on hand often does not match the amount that the accounting system reports. Inventory shrinkage is the loss of inventory that occurs because of theft, damage, or errors. When there is a difference between what the system says there should be and what there actually is, we need to make an adjustment to the accounting records so that the merchandise inventory count reflects the actual inventory on hand. So you have to reduce merchandise inventory. So your shrinkage, sometimes they'll call it shrinkage expense, inventory shrinkage. So that's obviously your debit. Your expense is always your debit. Some places might actually debit merchandise inventory. You'd have to do that to get rid of any damaged inventory. So you're going to debit inventory, and then you'll credit, and you'll debit that expense, whatever it is, and then you'll credit merchandise inventory to reduce merchandise inventory. So whatever you call your expense, I would say call it inventory shrinkage or merchandise inventory shrinkage expense, and then just to keep it separate from cost of goods sold. But some people might actually use cost of goods sold for that. So we're not going to do a lot of that, but just that you know, you have to adjust your inventory. Closing the accounts, not really any different. The only difference is you have a couple of accounts you didn't have before, right? So you're going to have sales revenue, right, instead of service revenue or rental revenue. You'll have now sales returns, sales discounts, cost of goods sold, and delivery expense. So you have a few more expenses that you hadn't seen before. Certainly you'll have the new asset, merchandise inventory, which is not closed, obviously. Only revenues and expenses and dividends get closed. So you'll have some new accounts. The new accounts used by a merchandising business are highlighted in blue. The new accounts introduced in this chapter are merchandise inventory, sales revenue, sales returns and allowances, sales discounts, cost of goods sold, and delivery expense. Merchandise inventory is a permanent account. So permanent accounts go on the balance sheet, right? We've already talked about merchandise inventory. It's a current asset. Don't close merchandise inventory. The income statement accounts are temporary accounts and closed at the end of the period. So, closing the accounts. After the accounts have been adjusted, the temporary accounts of the merchandiser are closed into income summary, so no different. We're closing things to income summary. It uses 4 steps. right? Use the 4 steps. The income summary account and the dividends account are closed. Revenues are closed to income summary. In the same way, expenses and contra revenue accounts are closed to income summary. So revenues get closed to income summary. Expenses and the contra accounts like allowances, returns, they get closed. Then the expenses get closed too, and dividends get closed, income summary gets closed, and you're done. Same thing, just all you do is you have to close the additional new accounts, which are either revenues or expenses. Alright, so let's talk about what's different about the financial statements. Alright, so obviously in a merchandiser we now have this cost of goods sold and gross profit we have to account for. So the formats for income statements are single step and multiple step. The income statement can appear in 2 formats, the single step format and the multi-step format. The single step income statement is the income statement format that groups all revenues together and all expenses together without calculating subtotals. So that's what we've been doing so far. So in chapters 1 through 4, all our income statement were single step. A single step income statement works well for service entities because they have no gross profit to report. A multi-step income statement is an income statement that format that contains subtotals to highlight significant relationships. In addition to net income, it will report gross profit and operating income. So let's take a look at these guys. All right, so here's a single step. So that should look pretty familiar to you. Revenues minus expenses equals net income. Right? A single step income statement does not provide subtotals. Now, here's a multi-step. So you'll see it's still revenues minus expenses, but you've divided them out. So at the top we've got sales revenues minus cost of goods sold, which is just an expense. So we have this subtotal gross profit, and then the rest of our expenses subtracted out till we get to net income. So it's still the same thing. We've just broken it into a couple of steps that are just more informative, right? A multi-step income statement details the calculation of net sales revenue. Remember, net sales revenue from the last video, we take sales revenue minus sales returns and allowance minus sales discount equals net sales revenue. Then we take out the cost of goods sold and we calculate gross profit. Then we calculate operating income by taking out the other expenses and get our net income. All right. Companies report operating expenses in 2 categories: selling expenses and administrative expenses. Right? So after we've done cost of goods sold and come up with gross profit, now we're taking out the rest of our expenses. So we divide those into selling and administrating. Selling expenses are expenses related to marketing and selling the company's goods and services. Administrative expenses are expenses incurred that are not related to marketing, right, of the company's goods and service. Gross profit minus operating expenses equals operating income. Operating income measures the results of the entity's major ongoing activities. Gross profit minus operating expenses. So if you look up here at this guy, you'll see after we do gross profit, right, net sales minus cost of goods sold equals gross profit. Then we divide operating and administrative, right? So sales expenses, rent expense, delivery expense, things that are related to selling the goods, and then administrative, everything, utilities, executive type salaries, things like that. All right, so we got those 2 categories of expenses. Then, after that, we're going to do some other some other expenses that are not really related to operations, and we consider those pretty much interest and taxes. You know, it doesn't matter about operations. Interest matters if you've borrowed money or not. It doesn't have anything to do with operations. And taxes is just whatever government entities are going to be charging you, so it doesn't really have a lot to do with your operations. After operating income, sometimes called income from operations, we subtract or add interest income or interest expenses, and if necessary, taxes before computing net income. Other revenues and expenses are revenues or expenses that are outside the normal day-to-day operations of a business, such as a gain or loss on the sale of plant assets or interest expense. Income tax expense is an expense incurred by a corporation related to federal and state income taxes. So what they're saying here is that if you're a retailer and your main job, let's say you're Target, so your main job is to sell groceries and knickknacks and whatever you sell as a Target. But let's suppose you close one of your Target stores and you sell the store. Right? Well, you're not really in the real estate business. So even though you maybe got some revenue from selling that, we would call that a gain. Or if you lost some money from something, we call it a loss, and we put it below. Because we don't want to confuse people and think Target made a whole bunch of money from selling that store, because that's not really their main business. So we put those out separate. We call them gains or losses. And so when you sell, you know, like if you're Coca-Cola Corporation, all your operations are from selling Coca-Cola, but you decide to replace your delivery trucks, so you sell the old delivery trucks. Yeah, so the old delivery trucks, that's not what you're in business for, so you would call that a gain or a loss, right? All right, so people don't get that mixed up. So that's the difference on this income statement, is you're just breaking it out into those multiple steps. Statement of retained earnings are the same. I mean, there's really no different. Beginning retained earnings plus net income minus dividends equals your ending retained earnings. There's no change on that. And the balance sheet, we've already looked at the current asset portion of the balance sheet back on the first video for this chapter. And you may recall all we do is add merchandise inventory as a current asset. So the balance sheet looks pretty much the same. The merchandiser's statement of retained earnings looks exactly like that of a service business. The balance sheet will also look the same, except merchandisers have an additional current asset, merchandise inventory. Service businesses do not have merchandise inventory. So this brings us to a brand new ratio we can use to help us think about whether a merchandiser is doing well or not doing well. Okay, and we're going to learn how to use the gross profit percentage. All right, and remember, at the end of the class, chapter 15, we'll incorporate all of these ratios. So we're going to really learn how, we're learning them one at a time right now, but at the end of the semester, we'll actually go through the financial statements and apply all the ratios. So don't forget about these. They will come back at the end of the semester. The gross profit percentage is one of the most carefully watched measures of profitability. It reflects a business's ability to earn a profit on its merchandise inventory. A small increase in the gross profit percentage from last year to this year may signal an important rise in income. Conversely, a small decrease from last year to this year may signal trouble. In general, a high gross profit percentage is desired. And how do you calculate that? Gross profit percentage is gross profit, so you take that right from the income statement, gross profit divided by net sales revenue, right from the income statement, and it gives you that percentage. So what percentage of my net sales revenue turns into profit, right? So if I have a high revenue and a large percentage, so in other words, 50% of my revenue turns into profit, that's awesome. 10% of my revenues turn into profit, that's not great, right? So you want your revenues turning into profit, and that's what that's telling us. The higher the percentage of your revenues turning into profit, the better. So that's all that is. All right, so that's it for Chapter 5. Hopefully you're all good on how merchandisers slightly differ from service providers, and the big difference, of course, inventory. All right, we'll see you on Chapter 6. Take care.